Welcome to Evangeline Ed Academy. Today, we are going to study about economic issues, Chapter 6.1 IGCSE Business Studies. Economic Issues Introduction. This presentation will cover the main stages of the business cycle like growth, boom, recession, slump, the impact on businesses of changes in employment, inflation, and GDP, how government control like taxes, spending, interest rates affect business activity and how businesses respond. Understanding the business cycle. What is the business cycle? The business cycle shows how a country's economic activity fluctuates over time, moving between periods of growth and contraction. The different stages of the business cycle are growth, where GDP is rising, unemployment is falling, and consumer spending increases. Boom, where GDP growth is at its peak, high inflation, labor shortages, production near capacity. Recession, where GDP falls for two successive quarters, business profits fall, unemployment rises, consumer confidence is low. Slump, the bottom of the cycle. High unemployment, very low demand, and potential business closures. Impact on businesses and the key indicators. Gross domestic product. The total value of all goods and services produced in a country in a year is called gross domestic product. How does it impact the business? High GDP is during growth or boom. This indicates a strong economy leads to increased consumer demand, higher sales, and greater business profits. Businesses are likely to invest and expand. Low or falling GDP means recession or slump indicates a weak economy, leads to reduced consumer demand, lower sales, and falling profits. Businesses cut back on investment and may reduce staff. Number two, employment levels. Impact on business. If it is high unemployment, it is during recession or slump, means it lowers the overall consumer income, reducing demand, but businesses benefit from a wider pool of labor available, potentially lowering wage cost. Low unemployment is during growth or boom, means higher consumer income and increasing demand, but businesses struggle to find staff, labor shortages leading to higher wage cost. Impact on businesses of inflation. It is the rate at which the general level of prices for goods and services is rising and subsequently purchasing power is falling. Inflation level high. During high inflation, the cost rises. For example, raw materials, wages, and other operating expenses increase. This shrinks profit margins if the businesses cannot raise its prices. Impact on consumers and sales during high inflation. Consumers lose confidence and reduce spending. Exports become less competitive internationally, and goods are more expensive for foreign buyers. During low or stable inflation, costs remain stable, allowing for better financial planning. Impact on consumers and sales. Consumers are more confident in the economy, encouraging steady spending and investment. What are the government economic objectives? Why governments get involved? Governments manage the economy to create a stable and growing environment for businesses and citizens. Their main objectives often include economic growth, that is, increasing GDP to raise the standard of living, low unemployment, ensuring most people who want a job can find one, low or stable inflation, keeping prices steady to protect consumer purchasing power, balance of payment stability, keeping the value of imports and exports roughly equal. To achieve these, governments use two main tools, fiscal policy and monetary policy. What is a fiscal policy? This is government taxation and spending. Increased corporation tax. This impacts the businesses by reducing profits after tax. Less money is available for business investment. Impact on consumer demand? None directly, but less business investment slows overall economic growth. Increased income tax, that is, tax on wages. How does this impact the business? This reduces the consumer's disposable income. People buy less non essential goods, leads to lower sales and lower profits for businesses. And for consumer demand, this decreases consumer demand. Government's action on increased government spending, its impact on business. This increases demand for businesses like construction, IT, education suppliers, creates new opportunities and boosts sales for specific sectors. How does this impact the consumer demand? It increases overall economic activity. Monetary policy, which is also called as interest rates. The central bank, on behalf of the government, controls the interest rate, the cost of borrowing money. The government's action on increasing interest rates impacts the businesses, which will eventually let the business to borrow. So the borrowing cost rise, higher loan repayments for businesses, reducing the profit. Hence, investment falls. Businesses are less likely to borrow for expansion. How does this impact consumers? High mortgages or loan repayments, less disposable income. Savings is encouraged. Consumers put money in the bank rather than spending it. How does this impact the demand? The overall demand falls, used to slow down the economy or control inflation. Let's say the government decreases the interest rates. Impact on business, borrowing cost fall, lower loan repayments, investment rises, businesses are more likely to borrow and invest. How does decreasing interest rates impact the consumers? Lower mortgages and lower repayments, more disposable income, saving is discouraged, consumers spend more freely. And for the demand, it overall boosts the demand rises. How businesses respond to economic changes. When faced with these changes, example a recession or a tax change, businesses must adapt. For a scenario like rising cost or inflation, the business responds by increasing selling price or look for cheaper suppliers. During recession, the business will cut prices or reduce production or inventory or lay off staff. During rising interest rates, they postpone investment or look for cheaper sources of finance. During high income tax cuts, increase to production or inventory and invest in expansion.